Big news, Silicon Valley Bank, the largest failure of a financial institution, I believe, since Washington Mutual collapsed at the height of the financial crisis more than a decade ago, and it had some immediate effects. So, Brett, do you want to take it away, get into that? You got a little presentation you've got that you want to talk about, probably?
Yeah, no,
You got nothing, do you?
No, I don't have slides
awesome.
this time. No, I don't have slides this time, and he's
okay, good.
typing that up, and
Nobody
I
wants
have
to look at slides.
Well, they don't get to see them, but I have clips and stuff lined up for the actual viewers.
Awesome.
And I will qualify. It was the second largest bank in U.S. history, but that doesn't count like investment banks, which we call them. Those are technically financial service. So Lehman Brothers in 2008, and I think Bear Stearns was actually bigger than this as well. Both of those are financial services. They don't count as banks, even though we all call them investment banks. Just to put that out there.
Okay.
I know. Yeah, it doesn't count. Yeah. Just for bank failures, just to bring them down a bit. But Silicon Valley Bank is the bank which we're going to be talking about here primarily. Formerly, I'm going to say, because they are going to end up being delisted at this time, they're just technically halted. They were symbol SIVB on the NASDAQ. So if you look that up, you can see their previous stock performance. It went from about 200 trading on a Thursday or Wednesday to 100 on the Thursday. And then now it's halted at about that $100 mark. But first, we'll go through the timeline of the event. Mid last week, Moody's, which is a credit rating agency, looked to downgrade the company's rating, which obviously in retrospect is pretty well done on a downgrade, which it should have probably been lower beforehand. Ratings like this are used by third parties to look at banks and other major depositors. So if you're loaning out money to them, you want to say, hey, they're AA, I'll give them this rate. If they're only a C, you'll give them a higher rate demanded. So you might require like the LIBOR rate, or I guess it's not LIBOR anymore, but plus spread. So might be 1% for AA, it might be 5% for C. So banks and other companies would want to keep the ratings high as possible to keep the cost down. So as the downgrade was pending, the bank, which I should say was pending because the bank's portfolio was severely impaired because of rising interest rates. When a bank's core operations is taking in deposits and loaning out money, interest rates will rise the rates of their loans and as well as securities, and it will decrease values as interest rates decrease. Aaron recently went over this interaction recently, and I'll put a link to that in the description. On Wednesday, March 8th, SVB tried to raise capital to stop this multiple notch downgrade. They were expecting at least one, but you want to stop a substantial decrease in rating. The company was looking to raise just over $2.2 billion in capital by selling stock. They had a non-committed private placement. So non-committed pretty much means they're involved, but they aren't legally obligated to buy at that point. And they have $500 million of that lined up. But this is where the market really took notice. Thursday the 9th, stock on opening plunged 60%. So Goldman Sachs bankers at this time were still putting together the deal, hoping to get about $95 per share. So that's still under half of what they were initially expecting on a per share basis. But as news spread of the risk and the depositors quickly withdrew, it started a bank run. Depositors just quickly, more and more, fell out. They were pulling out as much money as they could. This caused any potential stock placement to hold the bank together just to fall apart. Now on Friday, after the max exodus of depositors and their funds just completely withdrew, the placement failed as well. SVB had more deposits than assets backing them, effectively causing the bank to be both illiquid and insolvent at this time. So the FDIC, commonly known as, or the Federal Deposit Insurance Company, commonly known as the FDIC, wiped out all the bank equity, all the common and preferred stock, and as well, but not guaranteed the corporate debt holders. But at this point, it looks like they're not going to be getting even pennies back on the dollar. In other words, Wall Street got wiped out in this case. On Sunday, the FDIC guaranteed all deposits past the usual $250,000 insurance limit, meaning all depositors would be made whole. Only 2.7% of deposits were insured under the standard limit. At this point, I'll stress that if the FDIC did not do this, it would most likely cause a significant contagion event as other banks will start seeing depositors pull out, causing multiple bank runs, which we've already actually seen one additional one with SBY on Sunday. And if they were to not do this, you'd see more meltdown, and you'd likely see this hit the broad financial market and then into the real market. So your companies would start to fall apart. They can't meet payroll. So all those startups and all the other tech companies that were using SVB as their bank, they can't hit payroll next week. So people quit, people lose their jobs, they can't pay their mortgages, and you see how it plays out there. You'd have another 08, 09 financial crisis if they don't do anything. Obviously, that could play in the Fed playbook, since inflation is no longer a worry at that point. You see demand being crushed. But that's way worse. That's a super hard landing. That's not even a landing, that's a crash. So obviously, the government, they've released statements. They actually had a Congress meeting last night, and they needed to do something. So if you are in the US, this wasn't your money bailing them out yet. This was the bank's money indirectly. So I will put that out there, because I've seen people saying it's a government bailout. It's not. It's still bailout, but not a government bailout. So, and at this time, the FDIC is looking for purchasers. The UK branches were already taken over by HSBC for a grand total of £1. There's your buyout to buy a bank. So if you had £1 on you, you could have bought a bank. That's not really how it works. That's a bit of me being a bit facetious about it, but it's pretty much what it's done is the large banks have enough liquidity to support these short-term deposits, but they're absorbing the risk. But in exchange, they have the long-term potential of gaining their own portfolio sizes increased, as well as their own customer base. So really, what was the underlying issue here? As much as I would like to attribute it to the collapse to Jim Cramer's bullish remarks last month,
I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away.
The collapse is really due to fundamental issues. The biggest issue at play here, there were a couple, but I'm going to really focus on this one because they all revolve around it, was a mismatch of duration between the assets and liabilities. So when banks take in deposits and lend them out, like mortgages or investing securities like treasury bills, they're commonly called risk-free for those, but they're only default risk-frees. Because the government cannot default on them, really. They can, but for the most part, you expect them not to. They'll just keep on printing money. And I know this is going to confuse people. When I say printing money, they're increasing monetary limits. So as they are sensitive to interest rates, they'll eat these risk-free bonds and loans. They will be sensitive to interest rates, and this is called duration. Well, effective duration, I should say. That's the specific type of duration here. So for banks, if you don't want to see the negative impacts of interest rate changes or duration, they will want to match their asset portfolio with their liabilities, and liabilities in this case are the depositors. Effectively, money in via interest rate and money out via interest change at the same pace when your interest rates go down or up. Matching duration is called immunization, and this practice is very common. SVB did not do this. And I'll quickly address a few comments which I've seen rolling around the internet and common takes I've seen. It's the Fed's fault for raising interest rates. They caused the bank to collapse. Frankly, this is just a poor opinion. It's very dumbed down. Bank operations are directly linked to the change in interest rates. But there are many, many, many ways they can negate this risk. Like I said, they can immunize their portfolio. You can do this through interest rate swaps, which is trillions and trillions of dollars traded in notional value. It's not a hard position to get into, and it completely wipes out this risk. And they should be aware of this. But that being said, they didn't have a chief risk officer who would be responsible for this. They had 8 months without a chief risk officer. So if they just completely ignored it, this would be why. Because it would be right during that time. This was from April 2022 to the start of 2023, where these interest rate increases were taking place. If they were just not paying attention, there you go. Like, that's just a complete organizational failure at this point. If the CFO wasn't looking over it, the CEO, because normally if you have a sudden departure, you'd have someone step into that role. Clearly not. They weren't looking at it. Like, that's just an utter failure of this specific company. And as well, like I was saying, there was SBOI, which failed, which was Signature Bank. They as well had similar, most likely, issues. They weren't paying attention to the risk. The next comment I'll address is this was due to it holding crypto companies as depositors. Yes, they had high risk depositors, but the depositors weren't defaulting. They just had deposits in the bank. And this was nothing to do with the issue. If it was their loan portfolio failing, yes, but that's not the issue here. It was a duration mismatch. So purely it was just the banks not managing their duration risk, their interest rate risk, whatever you want to call it in this case. They're slightly different, but I'm not going to play semantics because it would have been the same thing at the end of the day. So not a crypto issue. It was just them failing to manage the risk. Lastly, I'll add, this risk is not over. We're recording this on Monday the 13th. Two more banks, the First Republic Bank and Western Alliance Bank, have both seen their stocks fall roughly 60% and 45% respectively. So it's most likely not over. We might see a couple more defaults. We might see a couple more FDIC takeovers, both having large unsecured deposit base like SVB and Signature. That's the risk which we're seeing at play here, which the people are targeting into withdrawal. And even strong banks ultimately can be taken out by bank runs, but the weakest will fall first. I want to emphasize that. So when you're complaining that the FDIC is now insuring what should have been insured deposits, this can happen to banks that were otherwise fine. Bank runs can affect any bank, not just ones that are poorly run like these. These were poorly run banks, obviously, but they wouldn't be the last if the bank runs are just keep on going. So I'll open it up to you guys here.
Awesome.
Yeah, no, it's a good summary. It's funny because you noted that on Wednesday, March 8th, SVB tried to raise capital. It's traditionally a day when I am trying to raise capital, as it's Candace's birthday that day. So every year I'm reaching out to try to cover the presents that she is paying for herself, right, on that day. But I'm kidding, actually. She doesn't do that. But that day, but regardless, no, yeah, it's something to watch. Like I think you were saying, generally speaking, when the Federal Reserve rates were near zero, banks were stocked up on long-term, low-risk treasuries. How are interest rates, nasty interest rate hikes? I mean, it's the value of those assets gradually reduced, leaving banks, sometimes sitting on losses. But in this case, it's something to look at when you're looking at banks. But this really does look like company-specific risk that went on poorly managed banks, and you can have any business that's poorly managed. Banks tend to involve, the entire community around that area, or if it's a regional bank, if it's larger, so there can be more of an impact. So a business fails if it's poorly run. In this case, it has more of an impact, but business poorly run, failing, and like you said, the point is, a bank run is going to hit these poorly run banks first. If there is further, it can be an issue for a well-run bank, and that could be an issue. I don't think we're seeing that right now.
No, I don't think we're going to see, you're not going to see the big 5 US banks fall apart. You're not going to see JP Morgan and Chase just fall apart overnight. They're actually backing some of these guys out, which it is actually a play for some of these larger banks. They'll look to buy them out. Like I said, the UK branches got sold for £1. If you could buy and weather the storm. And that's the thing. It's actually an opportunity for these guys.
Well, SVB has a large asset management business too. Like there's going to be opportunities there to gain clients. And if you just are smartly able to swoop in at the right moment, you're probably going to pick up some plum assets at some really bargain basement prices. So, I mean, it becomes an opportunity. But like you said, that is crazy. They didn't have a risk officer. I mean,
yeah,
you're seeing some of these things play out, like with Sam Bankman-Fried's company. Like there basically no risk. Money was so free in so many that you didn't have the checks and balances in place in these companies, which seems asinine, particularly with the size of the money we're talking about in like those two failures. It's unbelievable that you can't have basic risk assessment and basic risk controls in place. And it looks like in both of these, that wasn't in place, which is shocking, but you see it from time to time.
Yeah. I love, right now, the internet is just absolutely eating it up. Wow. That Joseph Gentile, who was the chief administrative officer at SVB. Well, his background essentially, and it's kind of funny, or at least I think that it's interesting that the internet's pointing it out, is prior to joining SVB, he was working for the Lehman Brothers, and he ended up retiring. He was the CFO for the Lehman Brothers, and he ended up leaving Lehman Brothers in 2007. So literally right before, the crash and Lehman Brothers obviously getting taken out or, going bankrupt. And then as well, he ended up starting his career at Arthur Andersen, which is the company that ended up doing the auditing for Enron, from my understanding. And I mean, I'm not saying that the reason this bank
basically anywhere this guy goes next, get the hell out of there. That's what you're saying, right? That's what you're trying to say.
The internet's undefeated. It's kind of funny.
Yeah.
I'm sorry for laughing. People lost money. It's not a funny matter, but I just love that the internet pulls this up. They're putting this guy's face everywhere, and just saying, well, wherever this guy goes, exactly what you just said, Ryan. Wherever this guy goes, you should just avoid. So yeah, I think that's kind of funny.
Well, jokes aside, I think it is a good thing to look deep into these management teams, because they actually did, this was a regular share sale, but they sold millions in stock the day before what they were going to sell their capital raise. So that's a bit questionable, to say the least.
Yeah, there's going to be a debate about those planned sales, right? They had this, I think it was the CEO, was it not?
CEO, CFO, sale. I think it was an entire C-suite.
Yeah. So, and the question is, did they know about the capital raise coming? And I would say yes, it happened within a very short period of time after. You have an idea of what's going on. I know, should that be allowed? It's predetermined, but should it be stopped then? Because you're gonna. I mean, clearly it was millions of dollars, right? That they put in their pockets right before the equity is wiped out completely. So strange. Yeah, and I think that may be talked about, and those type of plans kind of maybe revisited when you look at. I mean, these aren't everyday occurrences that a bank failing like that. So but you can't make policy based on potentially occurrences that are very rare. But in this case, it's really bad luck that's somebody's cashing out right ahead of that. Yeah, I read an article on that too as well, and it makes you sit back.
They pay bonuses as well, which was another thing.
All of that, you could go in the compensation. Anyways, I don't think we have enough time. No. We'll go on and on about that. Yeah. All right. Let's move on. That was a good summary, and we'll continue to watch that story, see if there is any fallout. Even the Canadian banks this morning were hit, right? And, kind of recovering
definitely some negative
by midday. Yeah. But some negative sentiment in that segment.